When you look at the balance sheet of a corporation, you will see common stock, and sometimes you see preferred stock. What this is a different class of stock, different ownership. Now, what does it mean to be a preferred shareholder? Well, preferred shareholders have dividend priority and typically liquidation priority. So what that means is, if there's going to be a dividend, the preferred shareholders will be in line ahead of the common shareholders. Think about going to an amusement park like Cedar Point. I know they have something called the Fast Pass, where if you have the Fast Pass, you don't have to wait in line for the roller coaster. You get to go right to the head of the line. That is what we're talking about with preferred stock. So if you're a preferred shareholder and the company issues a dividend, you're going to get your dividend before the common shareholders get theirs. In other words, the common shareholders, they get what's left over, and there's a chance they may not get anything. Now, this does not come for free. This dividend priority, this liquidation priority, usually means that the preferred shareholders do not get to vote. And that's why preferred stock really has elements of both equity and debt. See, the equity elements are, if you're a preferred shareholder, you own shares of the company. You have an ownership interest. You have an asset. And you certainly do get the chance to receive dividends. But like a debt holder, you don't get to vote. See, think about debt. If a company borrows money from a bank, that bank is certainly probably in line in front of shareholders for dividends, but the bank doesn't get a vote in the corporation's operations. The bank can certainly put other strings attached to a loan, but they don't get to vote. So preferred stock really has some elements of equity, like common stock, but it also has some elements of debt because of the lack of voting rights and the dividend and liquidation priority. Preferred stock can come in a few different flavors. Two that we're going to discuss are current dividend preference, and then in a few minutes, cumulative dividend preference. There are also some nuances. There's something called participating preferred stock. We're not going to go into that level of detail. So let's just take a look at this situation. We have a company that paid dividends for a couple of years, but did not pay them for a couple of prior years. And remember that dividends will not be paid unless the board of directors declares a dividend. So apparently, the board of directors did not declare a dividend for 2015 or 2016. They did, however, declare and pay dividends 2017 and 2018. So the question is going to be this: how much of this $160,000 or how much of this $200,000 goes to the common shareholders versus the preferred shareholders? And remember, the preferred shareholders have the fast pass. They're going to be in line first for dividends. That's the preference. That's a major feature of preferred stock. So what we need to do is we need to put some dollars here. Now, this disclosure, this is what you might see on the face of the balance sheet. It's 5% preferred stock. The par value is $100. So if the par value is $100 for each share, and there are 10,000 shares issued and outstanding, we can figure out the total par value of preferred stock. Okay? And the math isn't particularly difficult here. That comes out to $1 million. So in other words, the preferred stock that you would see on the balance sheet is $1 million. Now it's 5% preferred stock. So what we want to do now is grab this 5%, multiply it by the total preferred stock, and what that means is the preferred dividend is $50,000. If there is a dividend declared, the preferred shareholders will get the first $50,000. The common shareholders get what's left over. So if we look at for 2017, the preferred shareholders, they're in line first. They had the fast pass. They get $50,000. But the common shareholders, right, they get the remainder, which is $110,000. So you see the order of operations there. Once we know the potential preferred dividend, in this case $50,000, we allocate first the $50,000 to the preferred shareholders, and then the remainder goes to the common shareholders. Now, what about the next year where we had $200,000? I'm just going to kind of bring this one over here. What's going to happen with that is the preferred shareholders still get their $50,000, but now because the total dividend is greater, the common shareholders get the remainder. So you see what's happening here. Because this is not participating preferred stock, if it were participating preferred stock, here's the difference you would see, is that beyond this $50,000, the preferred shareholders then would be able to participate in the remainder, okay? But we're not going to go into that nuance in this discussion here. We're going to assume it's non-participating preferred stock with only a current dividend preference. So in other words, the preferred shareholders are definitely in line each year for the first $50,000 in this scenario, and then the common shareholders get the remainder. But here's the nuance with the current dividend preference. For 2015 and 2016, you notice the preferred shareholders may have been eagerly waiting for a dividend. Where's my $50,000? But the board of directors did not declare a dividend. Technical terms would say too bad, too sad. Okay? Each year stands on its own. So if there is a year when the preferred shareholders did not receive their dividend, that's lost forever. We only look at a year-by-year basis. Now that's going to be different in just a moment when we look at cumulative dividend preference. Now we look at a cumulative dividend preference. Our scenario is the same that we had just a moment ago. So the preferred dividend each year is still going to be the $50,000 that we calculated, based upon 5% times the total preferred stock of $1 million. But now we have this cumulative dividend preference. Now, what that means is we need to talk about a concept called dividends in arrears. Okay? You might think about it as being like a liability. That might be your first instinct, but we don't record it as a liability. We do disclose it. We do keep track of this. Okay? Because think about it this way. What it means is if there are years where we did not pay a dividend to anybody, preferred shareholders did not get a dividend, common shareholders did not get a dividend because the board simply did not declare a dividend. We're going to keep track of that, okay? And as we get to a stage where we actually pay dividends, we're going to make up for these sins of the past, if you will, okay? So by the time we get over to 2017, we have dividends in arrears of $100,000 because we did not pay a dividend in 2015. We did not pay a dividend in 2016. Then what happens is we get to 2017 and the preferred shareholders still get this $50,000. And notice what's happening. When we get to 2017, we're going to make up for all of this right here, okay? The $150,000. So not only do the preferred shareholders receive the current $50,000, but they're going to receive payment for the prior 2 years where they did not receive a dividend. So for 2017, what's going to happen is the preferred shareholders will receive $150,000. And since the overall dividend is only $160,000, the common shareholders get $10,000. Notice how significantly different that is if you're a common shareholder when compared with the current dividend preference. If you go back to what we did a few minutes ago, you'll see that when it was only a current preference, the preferred shareholders received $50,000 and the common shareholders received much more. But now, because there's this cumulative preference and we keep track of that dividends in arrears, once the company actually does pay a dividend, we're going to make up for that. And the preferred shareholders get a bigger dividend. Now, of course, when you get to 2018, the dividends in arrears have been satisfied, that it's been paid, so that no longer exists. So 2018, we get a fresh start, and the preferred shareholders get their $50,000 that you see right here, and then the common shareholders get the $150,000. So the primary difference between the current dividend preference and the cumulative dividend preference is that with the current preference, each year stands on its own. And if there are years when the company does not pay a dividend, the preferred shareholders simply lose out on that opportunity. But with the cumulative preference, we keep track of the years where we did not pay a dividend. And eventually, when and if the company does pay a dividend, we start to attack these dividends in arrears and pay those. Now, in this case, the 2017 dividend was sufficient enough to pay for all of the dividends in arrears for these 2 years, plus the current preference. And the common shareholders only get 10 grand. But next year, things are a little bit better. You could see why this would be very important to you if you're a common shareholder, because if you know that there are dividends in arrears, you know there's a potential for something like this to happen instead of something like this. And at the end of the day, the common shareholders need to know that information. It's relevant to their decisions regarding investment in the company.